Hi, everyone. Welcome to our Crypto and Blockchain Economics Research Forum that we started since May this year. And we have been hosting this monthly lecture webinar every first Thursday of the month. And what we're going to do today is to introduce a new webinar series that is more theme-based. The goal is to bring together scholars to present their work on specific topics within the space of blockchain and crypto economics. And this is in line with our general goal of CBER to bring together researchers that work on digital currency, cryptocurrency, blockchain economics to share their work, get comments, and also to discuss the latest developments in this field. So today we're really honored to have a set of distinguished researchers who have done work on the basic empirical patterns in the cryptocurrency space. That covers ICOs, initial coin offerings, the secondary market asset return dynamics, the manipulation and the regulation of crypto markets in general. And this is an important theme in that whether we believe the industry is emerging or it is not there to stay in the long run, or we think there are many problems with the cryptocurrency field or even blockchain, we have to examine the patterns before we conclude cryptocurrencies, only Ponzi scheme, or maybe there are unique roles crypto tokens are playing. And if there is market manipulation, how do we best regulate that? The three papers we have today are the following. The first paper is titled ICO Success and Post-ICO Performance. And it's going to be presented by Evgeny Leanders. It's about the primary market of cryptocurrency and also touching on the role of tokens in financing. It would be useful to see the key empirical patterns. In addition, it's also useful to know what type of data sources there are, which ones are more reliable. And I think the paper also has implications on IDOs, right? Decentralized exchange offerings, SEO, so on and so forth. Even if ICO is not the primary mode for financing through tokens going forward. The second paper is the structure of cryptocurrency returns. Emin Shams is going to present the paper. Here we're going to see the basic patterns in cryptocurrency, potentially as a separate asset class. And there are questions on whether we can use analytical frameworks that have been applied in other asset classes to value crypto tokens, to examine the price dynamics for cryptocurrencies. And once we see the basic patterns, how does that add to our understanding of asset pricing in general? These are all very important questions. And the third paper that we're going to see is cryptocurrency pump and dump schemes, and it's going to be presented by Dongwon Shin. And this paper touches on market manipulation. How do we detect that? What are the impacts? What are some of the issues cryptocurrency market brings that are either unique or perhaps shared across traditional markets and cryptocurrency markets? So without further ado, I'm going to pass the stage to Evgeny for the first paper.
Shows you exactly the same numbers that I showed you before, the evolution of the market. But we're basically looking here at kind of traditional ICOs, not the new variants of ICOs. We have three objectives here, and I'll try to focus on two of them. I think I lost Do you guys see my screen? Yeah. So the first goal is to construct the best possible data set of ICOs that we can trust, at least to an extent. When I started this project, this was not a goal at all, but we quickly discovered that for the most part, ICO data is not very good, right? I'll explain the reasons why. Most data comes from sort of aggregators of information. There is no regulator or centralized authority that collects data on ICOs. And so different aggregators cover different subsets of ICOs. Sometimes there is large overlap between them. Sometimes there is no overlap at all. But the biggest concern is that those aggregator websites often tend to disagree quite significantly on the characteristics of a given ICO. I'm going to give you examples on some numbers to understand the severity of this problem, right? So basically, the first goal is to try to come up with an unbiased way to create, as good a data set of ICOs as possible. It sounds like a not very ambitious goal to begin with, but it's actually easier said than done. It took us quite a long time to figure out how to do this. The second goal is just basically to use this data set that we constructed in order to re-examine some of the more important papers currently in the ICO literature, and that is basically papers examining the determinants of success of ICO, right? I won't be able to go into much detail in this, but I'll just mention that some of our results are novel to the literature, so haven't been examined before. Some results using this new or larger or more precise data overturn some results in the existing papers. Sometimes there is not too much agreement in the existing literature on the results, and we try to shed light on this disagreements. And some results are consistent with the existing literature, not surprisingly. The third goal is to go a little bit beyond looking at the success of an ICO. So basically, whether the ICO was able to raise money or was able to be listed on an exchange, and try to see what happens after the listing, right? So whether ICOs are actually able to deliver something, right? What are the determinants of how successful they are operationally, and whether operational success it has financial consequences. And in particular, we're going to focus on two theoretical models of ICOs by Gantsukalas and Nitesin, and by Kongli and Wang. And I'm going to go in a little bit more detail about this when we get to this part of the paper. There is tons of related literature. So ICOs are only 4 years old, but there is a lot of literature on ICOs and related subjects. So since ICOs are a source of crowdfunding, there is a big literature of crowdfunding that we can relate to. There are also, quite a lot of papers on the various economic effects of blockchain technology. We touch upon this a bit on the paper, but this is not the main focus of it. There is also a growing, theory literature on ICOs. We distinguish two types of theory papers. The first ones, there are only 3 that I list here, are those that we can easily test using, or not easily maybe, but test using our data. There are a lot of other papers that are extremely interesting, but that are not as easily testable, so they relate less to what we're doing here. And then there is, as I mentioned, quite a big literature on the determinants and consequences of ICOs. And in the empirical test, at least, our paper contributes mostly to this kind of last bullet point here. All right, so let me tell you a little bit about why my initial assessment was that the ICO data is not typically that great. What we do is we take data from 11 largest ICO aggregators, largest by coverage. The first issue is that matching among them is not trivial, but I'm not going to bore you with details. If you're interested, you can read about this in the paper, but this problem is solvable. Many times when I talk about this way of collecting data, I'm being asked, why not get data directly from ICO white paper? Most ICOs issue white paper. Well, there are plenty of reasons not to do this. First of all, not all ICOs have white papers or even project websites. So for those, using aggregator data is the only option. Another issue, which is quite big, is that information in white papers is updated quite frequently. So there are versions of white papers that are constantly being updated on the ventures or projects websites. So using a current, the most current white paper is not a good idea just because of the look-ahead bias, right? One potential solution to the look-ahead bias is to use cached versions of white paper that corresponds roughly to the ICO date. Now that turns out to be difficult. First of all, over half of white papers do not specify a date at all. In additional 18%, only the year is specified, and this is quite a fast market, so a year is not precise enough. And out of the quarter that is remaining, in only 1/3 of the cases, the date available precedes, or we can find a white paper with a date that precedes an ICO and is close enough, so within half a year of the ICO. So basically, we can reliably use data from white papers in only 8% of the cases, which is not enough. Now, going back to the aggregators, they actually have incentives to provide as reliable information as they can. The reason is that basically they derive their revenue from redirecting potential investors from their websites to the ICO websites. And so they do have incentives to provide reliable information, at least at the time of ICO. And they don't really have incentives to update their information because the revenue sources are kind of dry after the ICO. And so there are reasons to believe that aggregators do provide, in many cases at least, precise or close to precise information at the time of the ICO. But there is still a huge problem that the data provided by different aggregators tend to not agree, right? So we need to solve this, and I'm going to talk about how we try to do this. Just to illustrate the coverage of different aggregators, as I mentioned, we have 11 of them, right? And this table here basically says how many aggregators, how many aggregators cover a particular ICO. So for example, in about 32% of the cases, an ICO is covered by only one aggregator, right? In 340 cases, it's covered by 6. In only 5 cases out of over 5,000, it is covered by all 11 aggregators, right? So it's important to use, a superset of them, to be able to create, as complete a data set as possible, right? So, we start with about 7,500 attempted ICOs in all those aggregators. In about 5,300 of them, we have some data on crucial variables, and so this is really the data set that we're working with. So it's a big data set, probably one of the biggest in the literature, if not the biggest. Although I need to constantly update my my belief about this, by reading new versions of papers. So it's one of the biggest. But I think the larger contribution is data quality and not quantity. And let me talk about the quality of data. So basically what we want first is to produce some sort of an unbiased algorithm for assigning a quality to both data sets and to individual ICOs. And so we start with an individual ICO data, and for each observation or each variable in an observation, we basically try to compute the relative distance reported by a given aggregator from the consensus. Right? Then we take all observations for a given variable and for a given source, and we compute the so-called mean deviation, right? And that is a measure of how correct or how wrong a given data set is about a given variable, right? And then we adjust it to the overall quality of the variable reporting to compute the so-called relative mean deviation. Let me give you an example. So those are the 4 kind of main variables that many people, us included, focus on. So the amount raised in ICO, the hard cap, the token supply, and the tokens for sale. And let me just focus on the 2 red numbers here. You can see that in CoinGecko, which is one of the aggregators, is the most precise in terms of reporting of amount raised. The average deviation is about 6%, whereas CryptoCompare, which is another aggregator, is less precise, and it's wrong on average by 11%, right? And you can do this for all the variables and all the aggregators to get those numbers that we're going to use in a second. The reason we want to know which data sources report good data for given variables is that we want to pick from the data the most trustworthy pieces, right? So basically for each reported value of a variable for a given observation, we're going to take the inverse of the relative mean deviation of a given source, right? And this is going to be the measure of the quality of that source of the variable, right? And then we're going to sum up this qualities of sources reporting a given value to get us the so-called, quality weighted number of sources reporting a value for a variable, right? And we choose the value with the biggest quality weighted number of sources. Let me give you one example of Bancor, which was one of the largest ICOs of 2017. There's no disagreement about amount raised, so they raised $153 million. This is great. Only two sources report the value of hard cap, right? And they disagree widely. Obviously, 0 is not the right number. Now, the way we choose 36 million is by just finding out the Cryptocurrencies on average reports better data than ICO data on hard cap, right? And so our chosen value is 36 million, and we do the same for all the important variables in the future analysis, right? And then, we also want to compute the quality of data at the level of each individual ICOs to potentially focus on ICOs with the highest data quality, right? We want to take three considerations into assigning a data quality at the level of ICO. We want to look at the number of sources reported, the average quality of those sources, and the consistency among those sources. Once we take all of those into account, we get a number that is basically our index of ICO data quality for the particular ICO. In the case of Bancor, this number happens to be 1.5 approximately. Let's see how that compares to others. So this graph basically shows you a distribution of the number of sources and the consistency among those sources across ICOs. Those ICOs that with a lot of sources and data that is consistent are considered to be of the highest quality, so they're right here, right? If their data is inconsistent or if there are few sources, well, the quality of the data is not as good. And we confirm all our empirical tests on a subset of ICOs with the highest data quality, at least based on our kind of algorithm. Right. We also use data from a bunch of other sources. From ICO aggregators, we take additional auxiliary variables that are listed here. We also use white papers, but for variables that are less likely to evolve over time. So we measure white paper length, and we measure the informative white paper by counting the number of unique words identified using natural language processing. And we also compute the ratio of technical words, which is basically a measure of sophistication of white paper. We take return and pricing data from CoinMarketCap. We use quite heavily social media data from 4 different social media platforms, so Twitter, Reddit, Medium, and Bitcoin Talk. They're different, and I'm going to touch upon those differences in a couple of minutes. We look at code revision data, which is basically one measure of production of those projects, and GitHub is the platform that pretty much everybody uses there. And so we look at the evolution of commits or code revisions on GitHub. And we also look at the evolution of wallet holdings of investors and transactions in the token issued in ICO. And we take this data from those 2 last data sources listed here. Let me just very briefly go over summary statistics of our sample. So a mean ICO tries to raise $63 million. That's the mean hard cap. It tries to sell 56% of tokens on average. 52%, so just over half of them, of ICOs have a pre-sale or attempt a pre-sale, where basically they're trying to sell the tokens to some sophisticated or institutional investors such as VCs before the ICO, but very few of them succeed. So only 4% of ICOs are able to raise some money from from a pre-sale. A typical ICO project has about 11 members, and in 60% of the cases, we have some sort of industry information. We try to basically group ICOs into sectors that are listed here. 5 of them, but this is quite arbitrary. We also have information about location for the majority of ICOs, and we have it in our kind of empirical analysis, but we don't get too interesting results there. So let me skip that. But 37% of ICOs in our sample have a white paper, so that basically illustrates the importance of looking at aggregators that sometimes get information outside of the white paper by asking the ventures directly. A typical white paper has about 1,700 words, and 28% of those words are technical. So on average, this is quite a technical read. As to the outcomes, 45% of attempted ICOs managed to raise some money. If they raise money, the average amount they raised is about $13 million. Relative to their hard cap is about 43%. And out of the ICOs that are able to raise some money, about 40% of them list on at least one crypto exchange. In the last line here, you can see that there's quite a big dispersion in ICO data quality. You also saw this in a graph that I showed. And so again, we're going to exploit it by using only the best quality ICOs in some of the empirical analysis. We also, as I mentioned, have data on social media activity. I'm going to come to this later, and on GitHub and on wallets and wallet transactions. Let me say a couple of words about ICO returns. So if you're able to, if you were able to buy, those tokens at the ICO, then on average, you would get a huge return, right? Conditional listing, you'd get a return of 400%. This is obviously, the best of outcomes. So the unconditional return, so unconditional listing exchange, or basically assigning a minus 100% return to cases that are not able to list, you still get an average return of about 100%, which is obviously huge, but the median return is minus 100%, just because most ICOs don't list on an exchange. So it's a really risky business. The first day return, so the return the first day of trading, is very comparable to IPO first day returns, about 10%. Long-term returns are not great. The mean is, somewhat negative and becomes significantly negative, at a 1-year horizon. But the median return is pretty bad, right? So for a typical ICO, return after 365 days is minus 85%.
If Lenny, just a reminder that you have another 5 minutes before we get to the Q&A session. And
sure.
Harold also has some questions, which you can answer now, or feel free to defer that to the Q&A part.
Let me defer this to the Q&A to do everything together. I'm not going to take more than 5 minutes. I did spend quite a lot of time on the data just because I think it's important, but the empirical analysis is actually quite simple in this paper. So as I said, let me only focus on the last part, the second part of the empirical analysis. We do re-examine existing literature on ICO success. I'm going to skip this for the sake of time. Let me just spend half a minute talking about what kind of predictions are available in current ICO models. So there are models talking about factors that are associated with the choice of using ICO versus a traditional way of raising funds. I'm listing some of those papers here. This is not easy. This type of predictions are not easy to test just because, they're hard to find counterfactual, right? So it's not clear, what ventures thought about an ICO but chose not to do it, right? There are predictions about factors associated with ICO success. I'm going to skip those as well. What we are going to really test is couple papers talking about determinants of inputs into and output of post-ICO production process, right? And the important determinant is basically the skin in the game, right? So the prediction of this model by Gansu, Kallas, and Tessen is that entrepreneurs that sell more of their tokens to the general public or to investors are going to have less skin in the game, and that is going to impact both how much they work and what comes out of the ICO operationally, right? And then in the last part, we're going to basically try to see whether operational success of ICOs translates into financial success or returns as predicted by Conley and Wan. All right, so again, the first prediction is that the bigger the skin on the game is, the better the ICO is going to perform, and the more the entrepreneurs are going to invest in the venture post-ICO, right? And the second prediction is that, that is going to, bigger investment in ICO in terms of effort is going to translate in better operating performance in terms of product or platform adoption, right? So let me first talk about the first prediction, right? the effects of skin in the game on the inputs in ICO, right? And this this table shows that basically the more the entrepreneurs sell to the general public, so the bigger the percentage of tokens for sale in ICO, the less going to be the slower is going to be the growth in commits, right? And commits is basically code revisions by entrepreneurs and people associated with ICOs. We get similar results when we look at social media activity, and importantly, this is the venture-initiated social media activities. So basically, the more the entrepreneurs sell to the general public, the less they're going to update, the Twitter, the Medium, the Bitcoin talk, and so forth of the venture, right? And this is an important kind of way to deliver information to investors. They're going to do less of that, the less skin in the game they're going to have. This result holds for different types of social media activity. I wanted to talk about the differences between them, but I guess I'll be out of time. So let me mention the additional couple of results. Not only entrepreneurs invest less in the venture if they sell more of those tokens in the ICO, it also results in a smaller platform adoption, right? So basically, both in terms of wallets and the number of people holding those tokens in their wallets and the number of transactions in those tokens, in those tokens off chain, which is a measure of activity on the platform or product, we see that there is a clear negative relation between the percentage of tokens for sale and the growth in the number of people using the holding and using those tokens, right? The results are also very economically significant. If I had more time, I would talk about that too. The last result I want to talk about is basically how the operating success or the product or platform adoption translates into financial performance, right? And what follows from the model from Songling Wang is that there should be a link between the two. Their prediction is actually a little bit more precise. They talk about kind of the evolution of this relation over time. But what we basically see is that indeed there is positive, significant economical and statistical relation between the growth in the platform adoption measured by either the number of people holding the token or the number of people transacting in this token, right? That holds for all the horizons. And in fact, it is a little bit faster in the beginning of the post-ICO period and in the end, and that's consistent with the sort of S-shaped relation predicted by Songling and Wang, right? This is briefly what we do. So we had 3 goals here. First, to construct a good data set to the best of our abilities, to try to see how the finding of existing ICO success papers change, if we use this new, bigger, and hopefully higher quality data set. And we also try to test 2 important theories of ICOs, as I said, about the relation between skin in the game and operating performance, both input and outputs, and the relation between financial performance and operating one. Thank you.
Thank you, Yevgeny. This is perfect timing. We do have 5 minutes for Q&A, and we already have a few questions from the chat box. Maybe you can take a look and
I actually see no question in my chat box, so maybe.
Okay, so let me just bring the question to you then. Harold Ulig has 2 questions kind of related to the data set itself. Right? We talk about aggregators, and which are the sources of the data which you touch on, but what do they do and why do they do it? Why do they aggregate? Right. And, who has access to the listing returns? That's one question. One set of questions from Harold. Roger Lowe also has a question about survivorship bias. Is that going to be a concern? Are worse ICOs less likely to be recorded by aggregators? In other words, would the results here be for ICOs where data quality is good enough to be observed rather than for typical ICOs?
Right. So let me start with the first one. So what aggregators do? Well, they do everything that normal investors would, and that is collect data from white papers and digitize it and present it on their website. In addition, many of them go on further and question the ventures directly, right? So they basically try to get direct answers from ventures about some of the variables, the important variables in ICO. Now, why do they do this? Well, the biggest reason is that this is how they make money, right? So you go, you don't know, that an ICO exists. So you go to an aggregator, right? And you try to find out what are the upcoming ICOs, right? If you then click on this ICO, the aggregator gets, kind of some payment for referencing you to the ICO if you invest in it, right? So that's, to my understanding, part of their business model and why they do it. And that's why I mentioned that it is more likely that aggregators are going to have a more precise data than what I would be able to kind of download from a white paper. And part of that is due to their incentive structure, right? So they're interested in having an up-to-date and precise data at the time of ICO to direct investors to the ICOs. They're less interested in maintaining this data thereafter. They're less likely to basically get the data from later versions of white papers that are available online. Right? As to the survivorship bias, so it's definitely a concern. In our data, we see a lot of failed ICOs. So we see that, first of all, even ICOs that aggregators do cover, the vast majority of them do not succeed both in the short run and in the long run, right? However, we do have, some of the ICOs that aggregators do not have at all information for important variables, right? Now, this is, a tricky kind of question to answer, but we do not see, a big difference in the chances of success of ICOs that do have decent data or not, right? So if you basically, a very simple test is to regress our data quality measure on measures of ICO success, there's not much there. So there's not a clear ex-ante relation between data quality and success of ICOs, consistent with the fact that aggregators do not tend to update the information, after the ICO.
I guess the question is whether the success is going to be much worse. Suppose you could observe if there were a survivorship bias. So maybe the 100% is still over-optimistic.
It could be. There is also another type of survivorship bias that is actually, smaller now than before, and that is sometimes it takes, the ventures some time to succeed, both in terms of listing on the exchange and to succeed operationally, right? So that was a concern initially, but now our data set has ended about a year ago, and so this type of bias is less of a concern. But I agree that survivorship bias is always a concern. We try to argue that it's not huge in our setting, but of course, as in many other settings, it's there.
Evgeny, there's also a question from the Q&A box. Tyler Manzer asked a question. When looking at successful post-IPO, does transaction on the platform proxy for actual product development, or just a level of anticipation or speculation on the side of the market?
Right. So I completely agree. It could be both. We kind of try to argue, and I think this argument has been, raised before, that speculators, investors, tend to transact more on exchanges as opposed to, on-chain transactions, right? So, you would, if you're really interested in speculating, right, it's more likely for you to log on to Binance or any other, crypto exchange and trade there. It's easier than to try to find a counterparty on chain, although that's also possible.
Okay, that's great. I think we are right on time to move to our second paper. Emin is going to present to us his work on cryptocurrency returns, and we can continue the discussion after the 1.5 hour. I'm going to stay around and continue the session. But let's cover the 3 papers first. We can see the slides, Emin. You can start.
All right. Hello, everyone, and thanks to the CBER organizers for putting my paper on the program. So blockchain technology has shortened the gap, basically, between having ideas and defining investable vehicles on those ideas. And because of this, today, we have thousands of cryptocurrencies in the markets, and many of these cryptocurrencies may be scams, many of them might be fraud, but we also have many cryptocurrencies that they at least try to serve some specific services tied to the blockchain technology and provide some services more efficiently and more effectively. And these cryptocurrencies have a very active trading market. We have more than 200 cryptocurrency exchanges that work on a 24/7 basis, and we have a lot of retail investors. Institutional investors have shown interest in the market. And because of that, it's important to better understand the secondary market for trading cryptocurrencies and what's going on there, and specifically what basically determines price of these cryptocurrencies. So there are questions here: what drives cryptocurrency prices? What determines the return structure of cryptocurrencies? What's the source of the underlying value for these cryptocurrencies? And what's the traders or investors' belief about the underlying value? And there are different approaches, there are different frameworks to examine cryptocurrency prices. One is to focus on the factors that we know from stock market or other traditional markets and apply those factors to cryptocurrencies like size and momentum. One approach is to focus on fundamentals, technological fundamentals of cryptocurrencies like consensus mechanism, hashing algorithm, basically the energy consumption, token industry. And while my paper also looks at these characteristics as well, the main focus of my paper is on the demand side of cryptocurrencies. So basically the demand for holding cryptocurrency, because of its unique features, that can have a very important role here in pricing of cryptocurrencies as well. So we can even talk about the fundamentals of cryptocurrencies by looking at the demand side of the market for holding cryptocurrencies. If you imagine that cryptocurrencies have some sort of cash flows, that cash flow is endogenous to the demand for holding these cryptocurrencies and user adoption of these cryptocurrencies due to the network effect that I'm going to talk about it later. And Congley and Wang have a great paper there that's basically the underlying value of the cryptocurrency can depend on the demand for holding it due to the network effect. And because of that, I'm going to focus on that, on the demand side of the market, and just borrowing from the stock market and the literature in the stock market, papers like Barberis and Schleifer, Wegler. When you want to gauge the impact of investors or the demand side on asset prices, you can look at the common ownership or exposure of different assets to the same type of investor clientele and see to what extent their return or prices move together. So if there's a huge impact on prices, if prices of assets that have similar investor clientele, if they move together widely, that shows the price impact of the investor clientele. So that's what I'm going to do in this paper mainly. So before I start, I want to show you some empirical facts about cryptocurrencies. So as I said, I'm going to look at co-movement of cryptocurrencies. And before I talk about my results and my framework, I want to show you some empirical facts here. First, there is a wide variation in pairwise correlation of cryptocurrencies. So if you just, during my sample period, if you just calculate the pairwise correlation of cryptocurrencies, some of them show correlations of up to 0.7, and some of them have even negative, slightly negative correlation. So there is a wide variation in correlations here. And just to show you that this is not random, because if you have some randomly generated process, if you calculate correlations, you may get a distribution. Some of them randomly have a high correlation, some of them randomly have a low correlations. If you sort correlation of cryptocurrencies based on the lagged correlation, the correlation in the previous month, or that holds if you sort them based on correlation in the previous 6 months, and then look at the next month or the next 6 months correlation, there's a relatively persistency here. So those pairs of cryptocurrencies that were moving together in the previous month, they're going to move together in the next month as well. And those who had a low correlation the previous month, they'll have a low correlation next month as well. So this is not random. There's a persistent return structure here in cryptocurrencies. And another fact is that there is a wide variation in the market share of different cryptocurrencies on different exchanges. We have more than 200 cryptocurrency exchanges, and different cryptocurrencies have different shares on these exchanges. For example, Ripple, during my sample period, was heavily traded on 2 Korean exchanges here, BitHum and Coin1. And if you look at Bitcoin or Ethereum or EOS, they don't have as much trade on these Korean exchanges. So what I do in the paper, in the first part of the paper, is that I define a measure of similarity in exposure of different cryptocurrencies to similar investor clientele based on their trading location. So for example, those cryptocurrencies that heavily trade on these 2 Korean exchanges, they have a similar exposure to investors as Ripple. So they are basically closer to Ripple in that sense, in terms of similarity in investor base than Bitcoin or Ethereum. So what I test in the paper is that, are those cryptocurrencies that more similar to Ripple in terms of ownership or in terms of exposure to investors, do they move more closely to Ripple than Bitcoin? Okay, so that's one of the main questions of the paper. And just to give you an overview of the results, so I find that cryptocurrencies with similar size, trading volume, age, consensus mechanism, and token industry show significantly higher co-movement. So price of these assets move together. So for example, consensus mechanism, different consensus mechanism have different exposure to energy consumption and different factors. So shocks specific to those factors can move these price of these cryptocurrencies together. But what I find is that by far the highest co-movement is explained by exposure to similar investor bases that I proxy for by cryptocurrencies trading location. So I find that cryptocurrencies with one standard deviation higher overlapping exposure to investor bases show 0.22 standard deviation higher correlations. This effect increases in time horizon. So if you look at weekly returns or bi-weekly returns, the effect is stronger than if you look at daily returns. And it leads to a cross predictability. So basically, what I find is that if Ripple generates 1% higher weekly return than Bitcoin, those cryptocurrencies that are more connected to Ripple, more close to Ripple in terms of investor base, they generate almost 80 basis point higher weekly return than those cryptocurrencies that are connected to Bitcoin. Okay, and this effect keeps continuing over the next horizons as well. So not just in that week, in the next week, also those cryptocurrencies that are connected to Ripple generate higher return than those that are connected to Bitcoin. And I examined 3 potential channels here. One is that it could be just unobservable characteristics. Maybe those cryptocurrencies that are listed on the same exchange, maybe they have similar unobservable characteristics that I'm not able to control for. So I look at new exchange listing and also a quasi-natural experiment, basically a plausible exogenous shock to trading location of these cryptocurrencies. And I see that that explains their changes in their co-movement with almost the same strength. And so it's not, I don't believe that it's unobservable characteristics based on the findings of the paper. And next, I look at whether there is commonalities in cryptocurrencies investor demand that explains this co-movement. So I look at the order flows for different cryptocurrencies. And a nice setting we have here to study order flow is that for a given cryptocurrency, we have the order flow on several different exchanges. So each exchange for each cryptocurrency has a separate time series of order flows. And so because of this, I can decompose the order flows into exchange-driven order flow, a currency-specific order flow, and also a market-wide order flow. And I find that there is a very strong exchange-specific component that drives cryptocurrencies order flows, even after controlling for the same currency on other exchanges. So in fact, the order flow of a given currency on a given exchange is more correlated to other currencies on the same exchange than the same currency on other exchanges. Right? So this is the second result, suggesting that these co-movements are created by investor demand here. And the third channel that I examine is the network externalities of user adoption. So basically, because the value of cryptocurrencies can theoretically depend on the user adoption and participation of users and developers on a platform, when there's a buying pressure for cryptocurrencies, the fundamental may be affected, the underlying value may be affected, because that could be interpreted as a sign of user adoption. So I use social media data to divide cross-section of cryptocurrencies into those that rely more on the network effect and those that rely less. And I see that the effect, the co-movement effect that I document here, is basically 36% to almost 50% stronger for cryptocurrencies that highly depend on the network effect. And I'm going to talk about the paper. I'm going to rush into the first part of the paper in the interest of time, and I'm going to spend more time on this last part. So we have a growing literature here on cryptocurrencies, and I apologize if I'm missing any papers, but my paper directly relates to papers that examine pricing properties of cryptocurrencies. Liu and Savinsky show that cryptocurrency prices are not related to, don't have any exposure to traditional market like commodities or stock market. And they also show that there are some factors borrowed from traditional markets like size and momentum. These factors can price cryptocurrencies to some extent. We also have other papers showing that other cryptocurrencies have a high correlation with Bitcoin, basically. And my paper also relates to exchange frictions and basically these clientele on the exchanges. My paper is different because these papers here, like Makarov and Shore, they look at arbitrage across exchanges, but my effect is, it's not driven by arbitrage. Basically, even if you look at within the exchange, but across different cryptocurrencies, my results hold there. So it's basically about co-movement across different cryptocurrencies, not the price of a given cryptocurrency on different exchanges. And my paper relates to the network effect, Kong, Li, and Wang, Sakin, and Zhang, that basically relate the underlying value of a cryptocurrency to the user adoption and the network effect driven by the user adoption. The higher people around the world hold Bitcoin, the higher the value of the Bitcoin, because I can use it to transact with more people. All right, so in terms of the data, I use three main data sources. One is data on trading and price data. I have Coin API, I have hourly data and trading volume on more than 200 exchanges. Ico, I have less number of exchanges, but I have the entire order book. So basically I can see the quotes and trades, and I can form order flows based on the signed trades, whether it's a buy trade or sell trade. I can see it on Ico. And I have CoinMarketCap that has aggregate daily prices. I use these to cross-check these other data sources. So it's a process that I have in the appendix of the paper. So basically there are a lot of errors in the data. I need to cross-check them and flag the errors and fix them. I have data on technological features of cryptocurrencies, whether they're coins or tokens, cryptographic algorithm, consensus mechanism, token industry. I have that from different sources. There's so many sources for this data. I have the exact sources in the paper. I'm not going to discuss them here. And I have social media data. I have 25 million currency-specific comments from Reddit. So basically on Reddit, each cryptocurrency has, or many cryptocurrencies have their own pages, subreddit pages. So you know that this specific comment is related to Bitcoin or Ethereum or Ripple. And I have 25 million currency-specific comments from these subreddit pages that I use to mainly examine the effect of the network effect here. All right, so I apply filters to the data to only include larger and more liquid cryptocurrencies. My sample starts with 23 cryptocurrencies at the beginning of 2017 with almost 17 exchanges here. And then it ends with 485 cryptocurrencies and 130 exchanges in March 2020. There's a huge growth in the number of exchanges and also in the number of cryptocurrencies, but also comparing to the aggregate number of cryptocurrencies out there, I'm fairly including more liquid and larger cryptocurrencies in the sample. So there's a wide variation in geographical location of these cryptocurrency exchanges. And this variation can come with some geographical restrictions. So this is one of the main differences between cryptocurrency exchanges. Some of them are registered in South Korea, for example, like BitHum. And BitHum only accepts South Korean traders. You have to be a citizen of South Korea to register on the exchange. And there are also other type of restrictions, like Coinbase is registered in the US and you have to provide your social security number to be able to register on the exchange. And there's some other variations as well. For example, there's variation in identity verification requirement. Some exchanges have very strict requirements, and some of them you don't need to provide anything to register on the exchange. There are limits on deposits, withdrawals, and use of fiat currencies. For example, Zaif is a Japanese exchange that only accepts wire transfer in Japanese yen. So because of that, the majority of traders on Zaif are Japanese traders. And there are also differences in transaction fees that may attract larger or smaller traders. And there are also frictions across exchanges. And because of these reasons, these exchanges attract different investor clienteles. And these different investor clienteles can be distinct from each other that are formed on different exchanges. And importantly, there is a wide variation in the market share of different cryptocurrencies on different exchanges. So there is a difference in exposure of different cryptocurrencies to different investor clienteles. For example, as I said, Ripple has disproportionately higher exposure to Korean traders than Bitcoin or Ethereum. Okay. Based on this, I create a connectivity measure. I borrow that from Anton and Polk, 2014. I define a connectivity measure that captures similarity in the investor bases of any two given cryptocurrencies, any pair of cryptocurrencies at a given point in time. Okay. If two cryptocurrencies have exactly the same exposure to different exchanges, like Ripple say that it's 100% listed on South Korean exchanges. If you have another cryptocurrency listed on that Korean exchange, they have perfect overlap. So their connectivity is 1. But if we have another cryptocurrency that trades on entirely different set of exchanges, the connectivity is 0. And if there is a partial overlap between different cryptocurrencies, the connectivity measure can be anything from between 0 and 1. And this connectivity measure, if I just sort different cryptocurrencies into different clusters.
Yeah, sorry to interrupt. It's about another 5 minutes before we get to the Q&A, so you may want to speed up a little bit.
Okay. So I have to rush into my results, but so based on that connectivity measure, we can cluster different groups of cryptocurrencies. And for example, this graph tells you that Ethereum Classic is more similar to Litecoin in terms of connectivity exposure to investor bases than Ethereum, even though they have the same blockchain, the history of blockchain, Ethereum Classic and Ethereum, and they have very similarities together. Ethereum Classic is more similar to Litecoin, or like Bitcoin Cash is more similar to Ethereum than to Bitcoin. And Ripple has its own island here based on this trading-based connectivity measure. So the first set of results looks at to what extent connectivity, lagged connectivity in the previous month can explain the next month's correlation. And it tells you that one standard deviation higher connectivity leads to almost 0.24 higher standard deviation correlations. Basically, it means if two cryptocurrencies that are listed on exactly the same set of exchanges, they have 0.14 higher correlation than two cryptocurrencies that trade on entirely different set of exchanges. And I also control for other characteristics like size, volume, number of trades. They all have relationships with correlations, but by far the highest variation is explained by connectivity. And the results for a host of different robustness tests, I'm going to skip them here. And it's relatively monotonic. So if you basically sort cryptocurrency pairs based on the size of connectivities, those pairs who have a higher connectivity, they also show a very high correlation in the next month's returns. And this is sorting within the exchange. This is very important. So it's not necessarily coming from the cross-exchange differences between across exchanges. If within that South Korean exchange, if within all the cryptocurrencies that trade in the same denominators, they trade in Korean won. If you sort those pairs based on connectivity, because some of these cryptocurrencies are more connected because they are connected on other exchanges, even though they all trade on Bithumb. Some of them are more connected because of trading on the same exchanges outside Bithumb, and some of them are less connected. Within that exchange, using that exchange prices, the results hold almost as strongly. So those that are more connected due to being connected on other exchanges, they actually show a significantly higher volume. And these results show that they specifically show like if Ripple has 1% higher return than Bitcoin, then those connected to Ripple also generate a 0.75 higher return than Bitcoin on a weekly basis, and then almost 0.8 on a bi-weekly basis. So I'm going to skip these. I have an exogenous shock to trading location, and that exogenous shock significantly changes the co-movements between cryptocurrencies. The exogenous shock is due to shutdown of Chinese exchanges. I'm going to skip those as well. I'm going to go to the last part of the paper that examines the network effect. So as I explained, because of the network effect, demand pressures can have an amplified effect on cryptocurrencies because they may be interpreted as a sign of user adoption. So two cryptocurrencies that heavily rely on the network effect, when there's a demand pressure, they're going to show a higher co-movement than cryptocurrencies that have less reliance on network effect. And the way I quantify reliance on the network effect is by reading and labeling the comments on the Reddit pages of these cryptocurrencies. So let me show you some examples. If you read Reddit comments, these are all from the data set that I'm analyzing. I'm going to explain how I analyze it later. So it says you should look at community support and number of developers working on projects for a certain platform. There is no other project with network effect even close to Ethereum. Okay. This one says how many users can Coinbase onboard every day? Coinbase is a cryptocurrency exchange. The more people that own one Litecoin, the fastest the value grows. Okay. If you have Ethereum using Metcalfe law, so some of them talk with actually sophisticated languages. Metcalfe law, it's obvious why it's up so much as number of users has gone up so much. People calling it a bubble just don't get it. Sure, prices has gone up so much, but users and transactions has as well. So these are the type of comments that relate the value of a given cryptocurrency to the network effect. So I use 25 million comments like this. I read 10,000 of them and label them as whether they relate the value of that cryptocurrency to the network effect or not. And these are the comments that are labeled 1 because they value they relate the value of the cryptocurrency to the network effect. And then I feed a random forest model and label the rest of the 25 million comments, and then quantify the percentage of comment for each cryptocurrency at a given month that relate the value to the network. And these are the feature importance graph. I'm going to skip that. So this is interesting. The measure actually is very persistent and has very interesting features. So first of all, if you compare Bitcoin, Ethereum, and Ripple, you see that Ethereum has by much a higher network effect here than Ripple. And if you search for terms like network effect, user adoption, community building, and user demand, in the Ethereum community, these terms are used 6, 7, 13, and almost 17 times higher than those terms in the Ripple community. So this is not about the size of the network effect or the size of the comments. They have almost the same size, but the percentage of comments that talk about the network effect are much higher on Ethereum. And that also correlates well with whether these tokens or whether these platforms are a platform token or not. So Ethereum, Ethereum Classic, Cardano, that allow for decentralized applications and smart contracts, they have a much higher network measure based on my measure than Binance Coin or Ripple or Litecoin. And that's basically consistent with common sense about these tokens, that because having more developers and users on these platforms significantly improves the value of the platform, we see that people are more and more concerned with the network effect and user adoption on these tokens. So I have a bunch of tests like this that basically verifies the validity of the measure, or at least it shows that the measure is capturing something meaningful related to the network effect. And what I look is, I look at the interaction between connectivity measure and the network effect. And I see that those cryptocurrencies that have a high network effect, like above the median, they show a significantly larger co-movement when they have similar investor bases than those that don't have a network effect. So basically, if you expose two Ethereums, Ethereum 1 and Ethereum 2 with a high network effect to the same investor clientele, they show a lot higher movement in prices similar to each other than if you expose two Ripples. And the effect is almost monotonic. So if you look at, if you basically sort cryptocurrency pairs based on quantiles of connectivity, those cryptocurrencies that have a high network effect, this graph shows the difference in correlation between high network and low network effect. The difference between high and low network effect correlations is almost zero if there is no connectivity. But when you have these cryptocurrencies very connected, very similar exposure to cryptocurrencies, they show a significantly larger additional co-movement relative to low network cryptocurrencies. So basically, to conclude, I find that the return structure of cryptocurrencies is mainly explained by exposure to similar investor clientele. And the effect is by far larger than any other characteristics or any other measure of technological features and other aspects of cryptocurrencies. And I find that unobservable characteristics cannot explain this, but there's a strong exchange-specific common component in cryptocurrencies investor demand that derive the structure of cryptocurrencies, and it's largely amplified through the network effect. So basically a common theme here is that understanding the demand side of the cryptocurrency market, because of its unique features, because of the network effect, because of the impact of user adoption, could be an important starting point to understand cryptocurrency prices. So that's it, and sorry for going over time.
Thanks, Emin. So we only have 1 or 2 minutes for the Q&A. I'll read some questions to you. You can pick one to answer and continue answering them after we have the third paper presented. So Arash Aluz had a question on, are pairwise correlations in the common sample, or high dispersion is due to different sample period? That's one question. Baolian Wang also raised the question of, do you look at longer horizon return correlations, since they are more likely to capture longer term demand, whereas short term returns, return correlations can be affected by a number of other factors. You probably can see it in the chat box. Roger Low also asked about whether the connectivity is positively related to the absolute value of the correlation. And finally, Harold has a question, or a suggestion that maybe we should think about whether the correlation is due to the location of the exchange or the location of the trader, because it seems to be driven by where people live from some of the patterns we observed earlier. And finally, there's one more question Martin Van Oort has a question on, do you find the acceptance and growth of stable coins are reducing the impact of the measured connectivity on correlations?
All right. So
pick your favorite.
Yeah. Thanks for all the questions. I'm going to run into them very quickly. So basically, I look at the longer horizon as well, up to a month. But because of the limited sample period, I can't look at annual data. Like if I look at, I don't have that many time series observation. So if I look at monthly correlations, like if I look at monthly returns to calculate correlations, I see the effect even stronger. So I showed you when I move from daily to weekly to bi-weekly, the results become even stronger. So I guess the noise basically is diversified and can capture the effect. So Harold's point, that's actually an excellent point. And I have that on my to-do list to basically quantify differences between exchanges in terms of locations and some other measures of differences, and see to what extent that's coming from different locations, like two different exchanges in the same country, whether they're the same or not.
I mean, we probably have to move on, but please, feel free to answer the questions also in the chat box. Sure. There's actually one more from Chico. Do you think the correlation is due to arbitrage or just common investor space? That's one question. I'm going to ask Donghua to start sharing his screen. And in the meanwhile, I'll add one more that you can try to answer later. Andrew here at Cornell and I had a discussion earlier, right? When we look at Liu et al. Papers, it seems to be we're taking, kind of equity asset class or, fixed income framework to think about cryptocurrencies. What about just thinking about them as currencies? Do you find, a global factor or a slope factor, things like that? That might be interesting to explore as well. In any case, I'll leave you to respond to these questions, and let's have our third paper presented by Donghua Shin. So Donghua, the stage is yours.
Yeah, you can hear me, right?
Yes.
Okay. Thank you very much for including my paper in this wonderful program. My name is Donghua Shin. I'm an assistant professor of finance at UNC Kenan Flagler Business School. Today, I'm going to present my paper, Cryptocurrency Pump and Dump Scheme, and this is a joint work with Tao Li and Bao Lian Wang from University of Florida. What is pump and dump? Pump and dump schemes are a form of price manipulation, and such scheme was common in microcap stocks, but has recently become more and more popular in the cryptocurrency market. In a pump and dump, investors artificially inflate an asset price and sell expensively before the asset price crashes, as you can see in this figure. Then why is pump and dump interesting to academic researchers? Because it is quite informative for studying manipulation theories. Allen and Gale, 1992, classified the manipulation into 3 different categories. In an information-based manipulation, investors not only buy and sell the securities, they also spread out the false news in order to manipulate the price. In an action-based manipulation, investors take some fundamental relevant action other than just buying and selling the securities. In a trade-based manipulation, which is probably the most important thing to academic researchers, manipulators just simply buy and sell the securities to manipulate the price, and cryptocurrency pump and dumps fall into this category. Pump and dump is also quite informative for studying financial bubbles and investor behaviors, and it has very important policy implication, which is an important part of our paper. Then why is cryptocurrency pump and dump so interesting? As all of us may agree, the blockchain technology is becoming more and more important, and pump and dumps are very pervasive in the cryptocurrency market. But this is not the main reason. The main reason is cryptocurrency market provides an ideal laboratory to study pump and dumps. Why? First, identifying pump and dumps is much easier in the cryptocurrency market than in the stock market. In the cryptocurrency market, manipulators organize com channels in Telegram and disclose information on pump and dump attempts in real time. And it is very difficult to catch these organizers because Telegram is an encrypted messaging app. Therefore, the organizers can easily hide their identities. pump and dump attempts are revealed to the members free of charge. Therefore, we were able to identify these pump and dumps very easily. Second, because the effect of pump and dump is immediate and large and lasts for only a few minutes, we can rule out the possibility that the effect is maybe driven by other factors. So we don't have to worry about confounding false information or fundamental relevant actions. Therefore, this cryptocurrency market provides an ideal level, provides a clean setting to test trade-based manipulation theories. In order to explain how pump is organized in this space, let me use this snapshot. This is a snapshot of the big pump signal group in Telegram on July 4, 2018. The first message on this data is by organizer. The pump will be in 11 hours and 20 minutes, which means that, oh, we are going to pump something in 11 hours and 20 minutes. So you guys need to prepare for it. The next message is pump is in 1 hour and 30 minutes, and it is followed by another message that encourages the existing member to advertise this group. And the next message is 5 minutes left till the Binance firm, which contains a very important information, the trading venue, Binance. Next message, 2 minutes left, and eventually a few seconds before the actual scheduled time, which is 3 p.m., exactly the same as 3 p.m., the targeted token, the name of the targeted token is announced, Nexus. And after the pump and dump, these organizers do some performance evaluation, and they said the pump went decent, not too good, but not too bad. And let's take a look at what actually happened to this Nexus token at 3 p.m. on July 4th, 2018. And the time window here is between -1 hour to +1 hour around the pump schedule time. And this blue line shows the price movement of Nexus token in Binance. And as you can see, before the announcement, time 0, we barely see any price movements. But right after the announcement, we observe the very fast increase in price, right? And this increased price eventually converges to the original level. Then what about trading volume? You the red bar shows the trading volume, and you barely observe any trading before the announcement. Probably this token is quite illiquid token, but right after the announcement, you observe the dramatic increase in trading volume. So the main takeaway from this figure is there is a significant increase in price and trading volume around the pump and dump. And this very interesting and fascinating pattern has led us to study these pump and dumps more seriously by using more comprehensive data. We first identified the name of the pump groups in Reddit and Bitcoin talks, and after that we collected the pump and dump attempts of each group between May 15, 2017 and August 26, 2018 from Telegram. In many cases, multiple groups actually work together to target same cryptocurrency at the same time at the same exchange. So we collect these pump and dumps, targeting the same cryptocurrency at the same time in same exchange, and finally identify 500 unique pump and dumps, which involve 239 unique cryptocurrencies from 3 exchanges, Binance, Bittrex, and Yobit. And by trading volume, they ranked first, 36, and 27th globally, and they are based in Asia, the United States, and Russia. And we merged these pump and dump attempts with our trade level data. We use high frequency trade data, and for each trade we know price, trade size, and timestamp. And this is not only useful, but it is essential to document the price and trading volume pattern around the pump and dump, because as I said, this pump and dump is really, really quick and short. And also, this high frequency data is useful in studying the reason why outsiders are willing to participate, even though they on average lose money, as I will discuss soon. And we download the trade data for Binance using their own API, and we obtain the trade data for Bittrex and Yobit from Ico, which is one of the most reputable data providers in the cryptocurrency market. My first empirical finding is that pump and dumps are pervasive. We identified 210 pump groups, and from this group, we identified 3,412 pump and dump attempts in our sample period, which means that on average, we observed 7.3 daily pump and dump attempts. What's even more striking is sometimes we observe even more than 30 pump and dumps on a given day. So these pump and dumps are quite pervasive in this space. Then which cryptocurrencies are more vulnerable or more likely to be targeted? This table shows that typically smaller cryptocurrencies with higher trading volume and well-known cryptocurrencies are more likely targeted and vulnerable to the cryptocurrency pump and dumps. And what's the effect of pump and dumps? Let's first take a look at the short-term effect. Here, the x-axis, the window is from minus 10 minutes to plus 10 minutes. And blue line shows the average effect, and the dashed lines plots the 95% confidence interval. We have the plots for price, trading volume, and volatility. And as you can see, we observe an immediate and large effect. In the first 70 seconds, we observe that the price increased by about 25%, and trading volume increased 128 times. And 10-second absolute return, which proxies the volatility of the cryptocurrency, increased up to 15%. And due to its very, very clean pattern, it is very hard to believe that the price and trading volume and volatility changes are driven by other factors like confounding factor, for example, false information or fundamental relevant actions. Another interesting observation in this figure is, in the first figure, we observe the price run-up, which means that price actually starts to increase about 5 minutes before the announcement. And how can we explain this? Maybe this is very consistent with the existence of VIP members who actually receive the signal earlier than other outsiders by paying the fees to the organizers. And this actually highlights the unfairness existing in this market, which I'm going to talk about very soon. And long-term effect, eventually this bubble bursts in a few days. And in this analysis, we divide the pump and dump into several categories depending on the market capitalization of the targeted cryptocurrencies. And let's first take a look at, so I made 5 groups, and let's first take a look at the smallest cryptocurrency groups. In this group, we observe qualitatively similar patterns, and the effect of price and trading volume actually are a little larger than the average that we observe, which is not very surprising because probably smaller tokens are easier to pump and easier to make the price high, right? However, what's even more interesting is this. Let's take a look at the largest cryptocurrency group. For the largest cryptocurrency group, we still observe the similar patterns. So even very large cryptocurrencies whose average market capitalization is $144 million, which is comparable to the median of CRSP firm size distribution, can be pumped, and its effect is large. This means that pump and dumps are not restricted only to very, very small cryptocurrencies. So this is a very serious problem in this market. Let's think about what the arbitrageurs can do. Arbitrageurs may be able to take advantage of this opportunity. Let's think about the Nexus example in Binance. If the Nexus token is being pumped in Binance now, the smart arbitrageurs can go to the other exchange and buy a bunch of Nexus token and send it to their accounts in Binance and sell it at high price to make a lot of money. If that is the case, then we have to observe the increase in price, trading volume, and volatility of Nexus token in other exchanges as well. And this is what we observe in other exchanges. Actually, we observe some increase in price, trading volume, and volatility. But if you take a look at this figure very carefully, actually the effect, economic magnitude, is marginal. Only 2 or 3% of the increase in return and volatility, which means spillover effect to other exchanges is quite weak. How can we explain it? This is maybe consistent with the fact that the transactions in blockchain are slow, and therefore the arbitrage trading across different exchanges is unrealistic, which is somewhat consistent with the pattern that we observed in the recent working paper Leher and Poller, who documents very interesting friction existing in blockchain, Bitcoin blockchain. Here, let me show you some serious unfairness existing between insiders and outsiders. This table shows the trading performance of the different trading strategy depending on the purchase time and delay time. So if you take a look at the column before P&E and the first row delay time 0, we observe some number 13.9. This means that if investors buy the token between -10 minutes to -10 minutes and 0 seconds and sell it immediately after the announcement without delay, they can achieve 13.9% of the return on average. If they delay about 10 seconds and start to sell, then they can achieve about 18.4% of the return. And all these numbers in these columns are big, right? And also they are bold, which means that they are statistically significant. And this high return can be achieved only by the insider who know the name of the token, and therefore they can buy the token before the announcement. However, outsiders cannot do that, right? So outsiders need to wait until the announcement. And suppose the outsider buy the token 10 seconds after the announcement and try to sell it without delay, then they can achieve about 5.6% of the return on average. If they delay about 10 seconds, they can achieve about 6.95% of return. And this means that, oh, these numbers actually a bit smaller than the numbers in the column of before P&D, but this is still a good amount of money, right? So if the investors are quick enough, they have a chance to make some money. However, if they are late for about 20 seconds, there's almost no chance that they can make a significant amount of money. So what does this table says? This table says only a small fraction of outsiders who are very, very fast in buying and selling can make money. And on average, outsiders lose money. And this highlights the important wealth transfer between the insiders and outsiders. In the previous slides, I documented the unfairness existing between the insiders and outsiders. And in this slides, I will document another type of unfairness existing between different group of outsiders. If you take a look at the last column of the first panel, percent only, this is the fraction of pump and dumps in which the announcement occurs before the scheduled time. What does that mean? The good example is our Nexus token example. So Nexus token, actually the scheduled time was exactly the same as 3 p.m., but the announcement happened a few seconds before 3 p.m. So that is the example of this OLI. So we measure this percentage of OLI for each pump group, and we observe a big heterogeneity. Which means, as I said before, in many cases, multiple groups work together. And this table shows that, oh, some group actually received the signal earlier than the others on average, which means there seems to be some unfairness between different group of outsiders. And what's even more interesting is this unfairness is persistent. If you take a look at the second panel, we have the variable delay time. This is the number of seconds that elapsed after a scheduled pump time. So if this is long, then actually you receive the signal later. And if I regress this on the lag delay time, this is the pump group level regression. If I regress this delay time of the lag delay time, the coefficient is positive and statistically significant. And if I replace this measure with another measure of delay, only dummy, and regress it on the lagged only dummy, then we observe a similar pattern. What does it say? It says some group not only receive the signal later on average, but they receive the signal persistently later than the other groups. And this is a serious unfairness existing between the different group of outsiders. Then what's puzzling and what's interesting to know is, why do outsiders want to participate in pump and dumps? We have some suggestive evidence of overconfidence. Unfortunately, since we do not have individual level trading data, we infer investors' learning by studying the popularity of pump and dumps organized by pump groups. So we do pump group level analysis here. And we propose one important measure, early movers profit in the first 10, 20, and 30 seconds. And this is the profit of the investors who buy all cryptocurrencies or targeted cryptocurrency for the first 10, 20, and 30 seconds right after the announcement and start to sell them, assuming that they can take all the liquidity in the exchange where cryptocurrency pump and dumps happen. And outsider performance, this is by definition minus inside profit, and inside profit is the profit of the investors who buy all available targeted cryptocurrency between minus 10 minutes and 0 seconds, and they start to sell them right after the announcement, assuming that they can take all the liquidity in the exchange. And this is the result. The Y variable is the measure for participation, which is abnormal trading volume during the first 30 minutes period after the pump, and we regressed it on the recent outsider performance and recent early movers profit in the first 10, 20, and 30 seconds. Other variables are control variables. And as you can see, we find that the recent outsider performance does not explain the participation, although the coefficient is positive. However, the recent early movers profit in the first 10 seconds has the positive coefficient and statistically significant coefficient. What's even more interesting is this statistical significance disappears for recent early movers profit in the first 20 seconds and recent early movers profit in the first 30 seconds. Then how can we interpret it? Outsider participation is not sensitive to their recent average performance. It doesn't seem to be the case that average performance doesn't matter that much, but the participation is sensitive to the performance of very, very fast early movers. However, we all know that early movers profit is very, very hard to achieve. It's very hard to buy the token in the first 10 seconds. So this suggests that the average outsider could be overconfident and they could think that they can move faster than the others can. Other potential mechanisms could include gambling preference. So as you have seen, the short-term return on cryptocurrencies is very high and salient, and investors may overweight this returns or overestimate the skewness of the return. That's why they participate. Another very simple but not very interesting reason is maybe people just participate in this pump and dump for fun. Then what are the economic consequences of pump and dumps? We use natural experiment to answer to this important question because it is not only interesting, but it has a very important policy implication and regulations. On November 24, 2017, Bittrex, the US-based cryptocurrency exchange, banned pump and dumps. They simply froze the account of the individuals who participate in pump and dumps in their exchange. And this very simple policy was quite effective in reducing the number of pump and dumps in the Bittrex exchange, as you can see in this figure. This time 0 means the month of the November 2017, and before this ban, you see a big, very active pump and dump activities in Bittrex, represented by high blue bars. But after this announcement, we barely observe any pump and dump activity in Bittrex anymore. We see some, but not very much. We use this.
You have another 5 minutes. Just
yeah, that's enough. Yeah, thanks. So we use a difference in difference approach, and here the control group consists of cryptocurrencies listed on Bittrex, and we use propensity score matching to identify the reasonable control group. We use 5 variables: past market capitalization, past average trading volume, cryptocurrency age, past 5-day return, and the dummy indicating whether a cryptocurrency is a token or a coin. And finally, we identified 193 treated and control pairs. In this definitive regression, we use two main dependent variables. One is log normalized volume, which is defined to be log volume IT divided by the average past trading volume of cryptocurrency I. And the next measure is log normalized price, which is defined to be log price IT divided by past price of cryptocurrency I. Here what's important is volume IT is aggregate trading volume, and price IT is average price across all exchanges. So this is aggregated measure and average measure. And as you can see in this table, the effect of the banning pump and dump is significant. Not only statistically significant, but economically significant. The trading volume of cryptocurrencies listed on Bittrex increased by 21.2% more between -7 and +7 days. And if we increase the length of the window, the effect becomes even more pronounced. Then what about the prices? The prices of cryptocurrencies listed on Bittrex increased by 4.1% more between -2 and +2 days. And if we increase the length of the window, the effect becomes not only more statistically significant, but economically significant. And we observe some parallel trends. However, the cryptocurrencies listed on Bittrex could be inherently different from the matched cryptocurrency, which could drive our previous results. So we wanted to go a little further. If the ban made investors more willing to trade cryptocurrencies on Bittrex for a same cryptocurrency cross-listed on Bittrex and other exchanges, its Bittrex trading volume should increase more than its volume on other exchanges, right? However, due to arbitrage trading, we do not expect that for a given cross-listed cryptocurrency, its Bittrex price will increase more than its price on other exchanges. So basically, we do the similar thing, but here what we did is we decomposed the price as trading volume and price into Bittrex volume and non-Bittrex volume, and Bittrex price and non-Bittrex price, and do the similar exercise. Here, the beta 3 in our prediction should be positive for trading volume regression and should be insignificant for price regression. And that's what we observe. These results mitigate the concern because we compare the same cryptocurrencies, and any difference has to come from the difference of Bittrex and non-Bittrex exchanges. And it has very important policy implications. First, should cryptocurrency pump and dumps be considered illegal? Possibly yes, based on the criteria, based on the proposal by Kyle and Viswanathan. Kyle and Viswanathan of 2008 proposed two necessary conditions to classify a scheme as illegal price manipulation. The first condition is the scheme makes the prices less accurate as signals for efficient resource allocation. And the second condition is it makes the market less liquid. And our results, empirical results from DIP and DIP, suggest that the price cryptocurrency pump and dump satisfy both conditions, therefore should be considered illegal. The next question is it beneficial to regulate and ban cryptocurrency pump and dumps? The answer to that question is definitely yes, based on our result. Our results provide causal evidence that pump and dumps are detrimental to liquidity and value of cryptocurrencies. And importantly, Bittrex ban actually shows that banning pump and dump is also realistic. Regulations. Unfortunately, we don't have a clear regulation for cryptocurrency pump and dumps, but there was some move. In 2018, CFTC issued warnings to consumers about the possibility of cryptocurrency pump and dumps. So they warned the investor that, oh, don't be involved in cryptocurrency pump and dumps. Another interesting thing was CFTC's Whistleblower program. And this program incentivized people to report the cryptocurrency pump and dumps by rewarding them financially. And there are two main challenges in implementing and devising and implementing regulations. First, in the United States, there is no primary regulator for the market for cryptocurrencies unless they're securities. So probably the easiest, not easiest, the direct way to regulate this pump and dump is to prove that cryptocurrencies are security, that we can apply, we can use security laws. However, this attempt has been very unsuccessful, I think. Another indirect way to regulate this cryptocurrency pump and dump is regulating cryptocurrency exchanges. If cryptocurrencies are regulated, then customers will likely to go through more rigorous KYC, and this can reduce the pump and dumps. A good example is BitLicense in the New York State. So the licensee of this license must have a KYC program for the identification and verification of account holders. And my impression is that the pump and dump, cryptocurrency pump and dump is quite prevalent in the exchanges where there is no requirement for KYC or very weak requirements. And this BitLicense regulation is only applied in the New York State, and this is related to the second challenge, the offshore nature of the exchanges. The regulation have strong borders, but the capital does not, which means that, if the cryptocurrency pump and dump is banned in one exchange in the United States, and we can go to Russia, Yobi, to do pump and dump. So this means that regulating pump and dumps definitely needs international coordination. Let me conclude, pump and dumps are quite prevalent in this market, and we observe immediate and large effects on price, trading volume, and volatility. It was quite puzzling to understand why outsiders participate in pump and dumps in the presence of some unfairness existing in this activity. And we find some evidence, suggestive evidence of overconfidence to explain this. And in the last part, we show that using different regression, we show that pump and dumps are detrimental to liquidity and value of cryptocurrencies, and it has important policy implications. Cryptocurrency pump and dump should be considered illegal. And then banning pump and dump is realistic based on our experience from Bittrex ban, and its economic consequences positive and significant. Thank you.
Thank you, Donghua. Great. We have another 3 minutes for Q&A on this paper, and then we'll open it to general questions about all three papers, about the theme. And so Donghua, you can see the chat box. I think David Yermak was the first one to ask about.
Just a second, Will. So what can I actually click? Chat box?
Yeah, you need to click on chat, and I'll just repeat the first question to you. Sure. About whether banning the pump and dump is realistic, right? As you touched, so David was pointing out that many pump and dumps are not publicly announced, and many probably just aren't, and so it's hard to ban such pump and dumps if they're not.
Yes, but I think in general, I think banning pump and dump is hard in stock market because it's based on the price and trading volume pattern. We don't know whether that is actually pump and dump or not. But I think cryptocurrency pump and dump is a little different in a sense that the effect is quite salient. we observed like dramatic increase in price in a very short time, and dramatic increase in trading volume volatility. So I think in regulators' perspective, not regulator, exchanges' perspective, it's not very hard to detect the cryptocurrency pump and dumps. And also, in order to convince that it was actually a pump and dump, they can actually use like Discord or Telegram to see whether they actually attempted it. So although on average, I mean, in general, it is hard to detect pump and dump, but in cryptocurrency market, it's a little different, I guess. And I think Professor Campbell Harvey also asked a question, right?
I'm just going down. I think I saw Xin Cheng's question.
Okay.
I'm trying to locate all the questions. How do you match the accounts of outsiders with the members in the pump groups?
So it's impossible. I mean, so we don't use that account level data. We only use the trade level data, where from the trade level data, we cannot identify the account holders. So that's, yeah, I mean, it's impossible to obtain the more granular data. So we can do it, but we just guess that, oh, there is some effect by the insider based on the pattern in price and trading volume, because the price increased a little earlier than the announcement. Yeah, we can.
That's good. I'm able to locate Cam's question. It's in the Q&A box.
So I'm unmuted too, right?
Okay, yeah, you can directly ask the question then.
Yeah, so really super interesting. Do you think that the number of pump and dumps is just going to decrease through time? I kind of understand 2017 with all the euphoria, it drew a lot of people in. So specifically what I'm interested in is the difficulty of basically the arbitrage is decreasing. And I'm wondering what you think about these wrap tokens that are popular in DeFi with Compound and Uniswap, Aave, where you effectively have a token on a token. You can do arbitrage very, very quickly. And whether you think that that would be a force to decrease the probability that these pump and dumps are successful.
I think I mean, I don't know much about these tokens, but if based on your explanation, if that facilitate the arbitrage between exchanges, I think the probability of success of pump and dump will be lower, because if there is pump and dump, I think the reason why some pump is very successful currently is because there's a limitation in arbitrage. So you cannot easily arbitrage. So the effect of this weird trading is just concentrated on one exchange. But if people can easily arbitrage across exchanges, then I think it's going to be harder to succeed the pump and dump, I guess. And another question you had is whether the pump and dumps, the number of pump and dumps will decline over time. Our sample period is actually somewhat short. It ends at the end of August 2018. I want to first see the pattern now, but if there's more and more like advance in technology that allows more fast and efficient trading across exchanges, I think although people can attempt to do some pump and dumps, it's going to be harder to succeed or harder to achieve the returns, I guess. And I think this is a great question. I'll think more about it. Thank you very much.
Great.
Thank you.
So Zhiguo has a question on why pump and dump could ever be good, and then also Harold has a question on the related to the welfare conclusions. We do not know yet why outsiders like those by review preference they do, even though they lose money. So should that be taken into account when thinking about welfare? Before you respond to these questions, I also want to mention, we are already over time. For those of you who have to leave, please feel free to do so. We do have another webinar, the regular first Thursday of the month webinar coming up, and Harold will be sharing with us his work on cryptocurrencies and central bank digital currency. So Donghwa, you may want to respond.
Yeah. Let me first think about Professor Ziguo's question. So why can the pump and dump be good, right? Yeah, we don't know, but I think I read some articles about that that says some positive side or a positive potential of the pump and dump. I mean, through the pump and dump, people actually, there are so many, as Amin said, there are so many cryptocurrencies in this market, like probably over 4,000 currently. And through this pump and dump, some unknown coin or unknown token that is actually pretty good can get more attention. I mean, that was their argument. In that sense, I mean, there could be some positive side, although our prior is, I mean, pump and dump is in general probably bad. So that's what we actually show in different regression. And another question was about the welfare, which I haven't, which I think I have to think more about it. Yeah, I mean, so our evidence about why outsiders are willing to participate in pump and dump, of course, is limited because of the limitation of the data, and yeah, and that can actually affect. I guess that will affect negatively on investor welfare. But yeah, need to think a bit more about it.
Yeah. I also have a question related to the definition of market manipulation. Over there, you list two criteria, right? Quoting the paper from Whistleblower. One is it reduces liquidity. The second one is it affects price. So I've been looking into wash trading and faking volume and all that. That could be increasing liquidity, and okay, sometimes it doesn't have a direct impact on prices. So but that would be a I guess legal manipulation, but it's not price manipulation in that case.
Yeah, so this is probably only suitable or useful to define price-related manipulation, right? So in your case, yeah, but in your paper, so does actually liquidity increase by the fake volume? I didn't know that. I think that is just fake volume, which has nothing to do with liquidity.
Well, to the extent that it attracts more people to the market.
I see. I see your point. Yeah, then yeah, it can.
Yeah, changes and overall. And also, I'm abusing my power as the moderator, a host. I also have a question for Evgeny. The data sets that you've shown, it's very comprehensive. We like to work on the data sets that are, more accurate. So for all these data sets, for ICO and all that, what would you suggest, for empirical researchers going forward? Should we try to purchase data sets from all these sources? And Evgeny or Donghwa, feel free, and Amy, feel free to jump in.
Yeah, I think Evgeny has probably a better idea, but I wish, at some point, we actually somewhat share the data and check the quality of data together and make some like big or website that that provides the data for free to the public, so that actually to improve our understanding on cryptocurrency market. That's my hope, but I know that many researchers invest a lot of time and energy to collect the data and clean the data. Not sure whether they are willing to do, but I wish we eventually can do it to improve or to improve our understanding on this field. And
it would be great if there's a the shared pools that you guys can work together to construct that.
Let me stop share.
So I may add a couple points on that. So first of all, I completely agree. And in terms of my data specifically, I'm actually discussing with my co-authors the possibility of sharing this data with everybody. And I think the idea of having it in just one place, I think, will make things much easier. So I think this is great. And the only potential issue with this data or any data in this area is that it's evolving very rapidly, right? So even that that we use here, it ends about a year ago, right? And, in our case, not much has happened in this year, but in principle, lots of things happen in this area. And so, so the question is whose responsibility is going to be to update the data. So this is something to be thought about, but I think the idea is great. And, I personally will be trying to contribute to that.
Yeah.
Yeah. And Emin, do you have a remark on this, or or in response to the earlier questions that we had?
All right. I mean, it's a great idea. Some of the data, it's proprietary, so there are issues with sharing that. But there is also a huge database that I don't use it in this research, but I use it in my JF paper, that the blockchain data itself, it's a huge source of data that requires a lot of data cleaning and understanding the data, and it's public. So we can have, if we can share our efforts on that, and that could be pretty useful. It's a rich set of data where you can see transactions between different people, which we can see in many other markets. So yeah, I think that's also a huge source of data that's being somewhat neglected because of the complexity of the data. But
yeah, and I also just noticed that Martin has a question. I think it's related to Donghwa's.
Yeah, I'm reading it. Yeah.
And I also unmuted Martin if you want to speak, ask the question directly. I think you are unmuted. So
sorry. Yes. Sorry. It's a little bit noisy on my side. Yeah. One thing I wondered, like if you ideally, I think if you would like exchanges to detect these pump and dumps, they need to be able to establish rules, for example, based on returns, on volumes, or on volatility on these cryptocurrencies, because you can, especially if they are private, they cannot observe whether there actually was a pump and dump going on, or there are some informed investor who just made some really good investments. So I wondered, like, have you also analyzed kind of trying to specify such type of rules? And then I'm wondering, like, what would be potential false positive rates?
Yeah, that's a great question, and that's quite important in a sense of it has an important policy implication. But actually, there's a paper that tried to do what you just said. So based on the data, whether we can actually identify the pump and dump in the past. And that is the paper written by some like engineering PhDs or engineering professors. And they, as far as I remember, the result was not too bad, I guess. But the thing is, I'm not very surprised, because as you have seen in the patterns of pump and dump, in price and trading volume and volatility, the patterns are very, very salient. So I think it's probably not very hard to detect the pump and dump based on price, trading volume, and volatility, although it's not going to be perfect, but probably accurate enough, I guess. Do exchanges, yeah, so I think Andreas Park has another question. Do exchanges have an incentive to police pump and dump activities? I think, of course, there are two sides. One is if they do not actually ban pump and dump, they can actually enjoy high trading like fees, right? If there's more and more pump and dump activity, that's probably what UBIT is expecting. But in our definitive regression, after banning the pump and dump, we observed some exchange-wide increase in trading volume. And we observed that the trading volume of the same cryptocurrency listed on Bittrex and non-Bittrex exchanges, we observed even more increase in trading volume for the cryptocurrency listed in Bittrex, right? So in the long term, I guess, banning pump and dump is definitely helpful to achieve better liquidity, and not only that, also higher trading fees obtained from the investors, I guess. So that's, in that sense, I think they have an incentive to police pump and dump activities.
Yeah, I hope that you can unmute yourself. Yeah. Okay. I don't know if there are more questions from our audience. And if so, please, you can raise your hand and I can unmute you to ask the question. But if not, we are quite a bit over time already. Just a big thank you to all our presenters, panelists, and authors on these great papers. It's good to have, the basic patterns straight related to cryptocurrency markets. And I think that's going to lead to future research in this area or on these related topics. So if there's no further question, I'm just going to conclude our session today. Thank you again. Thank you for attending. And please definitely follow our future events and webinars.
Thank you very much.
Take care.
Thank you.
Thank you very much. Thank you.
Thank you. Wow.
I'll see you guys.
Thanks much, Will. Thank you. See you.